Not to be identified. Okay, all set.
Okay.
Share with your favorite friends.
Thank you very much. Okay, so this is a joint work between myself, Vincent, and Stefan. Vincent was at AHL for summer. Stefan, and he just finished his PhD at Oxford at OMI. Stefan was his advisor. He's well known, of course, in machine learning applied to finance. So, again, yeah. Oh, okay. And this has been published, Journal of Banking and Finance. Somewhat unusual to be able to publish a computer science related thing in a finance journal. They're quite picky, but that was you have to find a way of appealing to them. Okay, there might be a way to do it. Okay. So to state the problem, there are an abundance of performance measures in quant finance. There's Sharpe ratio, there's Kalmar, there's drawdowns, there's ways of evaluating your performance. And I don't think I did a good job of highlighting this this slide, but okay, we'll see. This one is going to be split in two. So typical goodness of fitness metrics are not necessarily aligned. You may want to maximize the Sharpe ratio, but it may hurt the Kalmar. Typically when you're looking at optimizing a strategy, you don't necessarily have a single measure for which you can judge it, and oftentimes they work in contradiction. So but moreover, typically people optimize the sort of two-step methods. You forecast, and then you plug it into an allocator, and then with the allocator you try to come up with some sort of strategy, some frequent reallocation. And then you look at the performance of that. And so it's typically through two steps. It's similar, there'd be a similar problem. This leads to a bias, in fact. So you typically minimize the forecast error, minimize the mean squared error, the MAPE, something like that. Then you re-optimize the portfolio allocation and tune your hyperparameters by backtesting. That's typically biased and inefficient. Just the idea that you have rather than trying to forecast in one go or try to solve your problem in one go. And we have the same problem in mean variance optimization. In mean variance optimization, typically the way it's typically used, you maximize the mean, you find the means of your assets, you find the covariance through some maximum likelihood estimate. Then you plug it in and you use that to do an allocation. But the means and the covariance were uncertain. And you tried to minimize the forecast error in them. It's not the same thing as minimizing or maximizing the possible returns of your strategy. And so doing it in one go is a means of trying to reduce this bias. Now, signals that we would consider can be simple. They can be simple moving averages, exponentially weighted moving averages for trend and mean reversion. We can consider price levels and features from other markets, and carry and things like that. But as I said, there are possible alignment issues in the case of the single asset and the case of portfolios. So what we'll look at today is the single asset framework initially. We'll talk about how this a generalization of Markowitz for portfolio optimization, and then we'll look at use of canonical correlation analysis as a means of analyzing the multivariate framework. Okay, so let's see the single asset strategy. This is something that Adriana and I looked at. Suppose you wanted to maximize the Sharpe ratio or utility. And you're optimizing a strategy with weights theta and the price changes delta p. We allow for theta to be a random variable. So we may consider that. So we may want to just maximize the expected value of theta times change in price. This of course can represent. We can condition theta being that it's modeled weights. That depends on random features. In the simple case where theta is just like a linear regression. The x's being simple moving averages, exponentially weighted moving averages, crossing moving averages, something simple like that. Then we'd be interested in how do we maximize this over our hyperparameters beta. We know that when theta and delta p are centered at 0. Gaussian and mutually normal, then we can express them all in terms of rho, sigma, and rho in the various different sigmas. And it turns out there's a simple formula. If everything's Gaussian, there's a simple formula for this. The Sharpe ratio, remember, it's the mean divided by the standard deviation. The standard deviation, if you have two Gaussians, you multiply them together, you get a correlation term. If you have a variance of Gaussians due to Wicks or Isserlis, it's all reducible into things like correlation as well. So it turns out in a simple case, they realized Sharpe ratio is just the correlation divided by the square root of the correlation squared plus 1. That's in the case that everything is Gaussian and mutually Gaussian. And this is on the frequency of the rebalancing. So you see these Sharpe ratios are nothing to write home about. A Sharpe ratio of 0.75 is not that special. No one's going to give you capital to do that unless you work in a bank, you work in a QIS team. But this is a daily Sharpe ratio. If you annualize it, multiply the square root of 252, we get a Sharpe ratio of close to 11, and no one's ever seen a Sharpe ratio of 11. Typically the types of correlations we're interested in are way over here. You know, they're like 5%, 10%. That's something that's really good. It's a correlation between your forecasts and your returns. So what we say here is that the maximizing the correlation, because due to the monotonicity, is equivalent to maximizing the Sharpe ratio. As a consequence, beta shouldn't be fit just to minimize the forecast errors. It should be maximizing the correlation if your goal is to maximize the Sharpe ratio. So maximizing the correlation, and that actually turns out that the numerical analysts have been studying that for a long time. It's called total least squares. And if you look in books by Van Loan and Golub and Van Loan on matrix theory, they'll tell you all about total least squares. It's very similar to PCA. It's instead of minimizing the error in the y direction, it's minimizing it in the orthogonal direction always. So I can tell you can actually figure it out in terms of PCA in this quite straightforward fashion. So maximizing rho is equivalent to maximizing the Sharpe ratio, and beta should be fit by total least squares. And that's something that Adrian and I looked at. So when all else goes wrong, but total least squares goes right, we looked at in ours, we looked at the case of a Holt-Winters type strategy. Holt-Winters is a double exponential moving average. So it's like it's sort of like there's an exponential for the levels and exponential for the slopes. And you can look it up on Wikipedia. It's very simple. People have used it for a long time. It's a pretty decent forecasting method. And there's two parameters in it. And it turns out if you vary these two parameters, we just did so over a grid, and you measure the mean squared error relative to the Sharpe ratio, there's not a particularly good mapping. So so sometimes you can get really, really good fits and really terrible Sharpe ratios. And this is not even accounting for transactions. Whereas the rho is very closely related to the resulting Sharpe ratio. The higher the correlation, the higher the Sharpe ratio.
The mean square error and the rho are linearly dependent. I mean, the one is divided the variance.
One is divided by the variance. Yeah. So
The same object essentially.
So minimizing mean squared error is the objective function. It's like, you know, if you have just a single one dimensional, you're minimizing the error in the y dimension. And if you are, and there's no but I think somebody was using one behind here.
Was there?
There was one there. There we go. No, thank you. Thanks. So if you have your data and you fit this is minimizing mean squared error. You know, you're minimizing the difference between your data and your mix. So y minus y hat squared minimizing that's lower less. Whereas TLS would take the orthogonal direction. So this is called orthogonal least squares. And it's a type of, econometricians would call it a type of errors in variable formula. It's as though you're saying, y equals beta times x plus epsilon plus, plus a different epsilon x, epsilon y. And you're assuming both have those. And it turns out it's very well studied. I'm not saying that this is a particularly fruitful way of going. It may be interesting. We looked at it in some detail, but what I wanted to point out in particular was that if you just measure it, the correlation was much more closely related to resulting Sharpe ratio than was the mean squared mean squared error versus Sharpe ratio. Oops, I have to go back. Now, what about if we did it in multiple dimensions? So this is quite different. Turns out that Brandt and Santa-Clara, this is in, I think it's Journal of Finance, 2006, considered the case of what they call conditional portfolio rates. So if you wanted to maximize, this is a typical Markowitz. We have W's outside of everything. But they assume that the W's were affine. They assume there was a linear, a constant part plus this linear part. We're only going to be concerned with the linear part. And they were considering specifically, like, I think they were interested in economics, like under different economic situations, what allocation should you have? And they decided rather than to forecast using these variables, why not let's just stick it in? And when they stick it in, they get a very, very large system. So what they called it, they said, let's consider augmenting the asset space. So we had to take the Kronecker product of our features and our returns. And so it becomes very, very high dimension. And it's possible to solve, of course, if you care to, but the issue is there's not a lot of structure in it to understand how it works. So this is the what they proposed. They did it in very simple cases, and I thought this is something that we can move forward with and consider in a slightly different detail. So now, note that A is given by the unraveled elements of theta. So before we have A is the weights are a vector, the x's are a vector, A is a matrix. If you take this Kronecker product, economists love to do Kronecker products. They love to blow up dimensions of matrices all the time. This theta is just like stacked versions of A. And so A is unraveled elements of theta. But the question is, can we find more structure to this high dimensional problem? And in fact, we can, but we have to make some pretty extreme assumptions. So if we consider instead, let's say linear portfolio policies, where A is this, okay, we're saying Vincent loved square matrices. I don't love square matrices. So we can have non-square matrices, but here let's say n by n. But let X and R be jointly Gaussian. Okay, so our features, basically we're saying that we're going to fit a regression, and then at the end of the day, we're going to see our features and come up with a forecast, and we're going to hold for the next period, but we wanted to optimize beforehand. We don't want to see the features and then decide what to do. It's already coded up for us effectively. So as a sort of linear policy. And effectively our P&L is then xt prime a rt plus 1. And if we wanted to look at the investor's problem, okay, there's various different ways of posing this. This is a you wanted to, here we can maximize utility. Here, this is minimizing the risk subject to a expected gain, some sort of minimum gain, some target return. Now, it turns out if we assume everything is Gaussian, everything is solvable. We just have to mess about with a lot of Wick's formula. And so A is a constant over time. The investor's conditional problem is equal to investor's unconditional problem, and we can solve that. Let's see. It turns out using Isserlis or Wick, actually maybe Wick was earlier, but physicists like Wick, mathematicians like Isserlis. I think actually they were contemporaneous, so I don't know if this date is correct. perspective yields that this PNL is just a cross, it's a trace of A and the covariance of sigma and R and X. That's what we care about, is this large covariance. The variance term, there are two parts to it. And I think that the coefficients aren't quite right here, but there's a sigma XA, sigma RA prime, and there's a sigma RXA, sigma RXA. We claim that this was smaller, or this was a higher order term, because it's almost like a quadratic term. We zeroed it out, partially out of convenience, but actually there's some sort of good empirical justification for it. So now we've got this. It still looks like kind of a mess, and it turns out the solution, the optimization, is really not that hard. It's equal to the weights are equal to this times xt, where where lambda is equal to this factor. In fact, the way I initially solved it, I had to change coordinates a couple of times, and what we found is that if you don't ignore this term, if you mess about with the functional form of A, you find that the A's actually can be put in terms of the canonical correlations of R and X. Now, canonical correlation analysis, it was invented by Hotelet in the 1930s. And let me just tell you what it is essentially. It's basically, we have two variables, say, okay, they have R and X, the two random variables. We want to find the A dot R and B dot X such that the correlation, we want to maximize over like A equals 1 and B equals 1. And that's the first canonical, and then that correlation, row 1, is the first canonical correlation. These we would call the canonical variates. And then it's actually quite straightforward using a singular value decomposition to find the second canonical correlation, which is orthogonal, second orthogonal, and the third orthogonal. Just pops right out. You find it quite easily using relatively straightforward software. So that's the canonical correlation. And so and effectively what we're doing by doing this is if we have we're finding a linear combination of assets that's most highly correlated to the linear combination of signals. And it's effectively the most forecastable set of assets. And the second canonical correlation would be the second most forecastable set of assets. And we can put things basically in terms of that. Unfortunately, I'm not going to do that quite yet, because it turns out it's relatively straightforward here, if ignoring that term. But as you see here, this looks a bit like a correlation. Sigma Rx divided by sigma R divided by sigma X. There's a bit of a correlation type thing going on here. So basically typically we would do as we say, a two-stage process. We do a multivariate linear regression of the returns on the signals, and then we do gas allocation. Here we've combined them into a single state. So it's sort of a joint selection process. And okay, let's see here. There's various other different ways of doing it. Fully invested, sum to one solution. A lot bigger matrices being thrown about here. A dollar neutral version. Now Markowitz back in 1952, he didn't look at conditional returns. He looked at unconditional returns for assets. So he didn't worry about the other component. Now, Brandt and Santa-Clara, of course, they looked at this much higher dimensional, this n squared by n squared dimensional problem. It's less computationally tractable in large dimensions, and there's no clarity on the structure. Now, more recently, Kelly, Brian Kelly, Malamud, and Pedersen. So Kelly is at Yale and AQR. Pedersen is Copenhagen and AQR. I think Malamud was a graduate student probably. And they looked at what they call principal portfolios. They looked at exploiting cross-covariance matrix, but ignoring this cross-sectional information from the returns of the signals. They had a slightly different objective function. And their empirical analysis is typically based on a small universe and monthly rebalancing. We wanted to reproduce theirs and use it as a benchmark. So let's use CCA as a strategy. Okay, as I said here, and I'm repeating myself, canonical correlation analysis, following in 1936, was finding some vectors such that we maximize the correlation. And it's not just any old vectors, we have to have them with, I mean, it was a correlation, so you don't really care about scalings, but typically normalize the fixed normalization of vectors. So rho is the first canonical correlation, and V and W are the first canonical directions of canonical variates. And then you just keep on doing that. It's used in machine learning. It's used, there's something called multi-view analysis, where people do generalized canonical correlation analysis, finding correlations between 3 or more sets of variables. So it could be images and sound and something else. And that's what it's used in sort of for multimodal analysis effectively. Rather simple. It's not like people do multimodal neural nets, but then people use this multi-view analysis in machine learning, typically through kernel methods. GCCA was a method that people use. There's an extension to nonlinear or kernel-based versions. So, of course, John Shaw Taylor is one of the big proponents of that. KCCA, and also it's possible to use partly nonlinear. Problem with kernel methods is that typically use some nonlinearity on both the X and the R. And we're only allowed to have nonlinearity in signals. We can't allow you can have nonlinearity in returns if you have you're able to trade any weird option on this, but we can't assume that. We just want to assume that we have some delta 1 portfolio, and we can transform our signal in some nonlinear fashion. And that's a possible extension to this work. Something I've had a student work on. I'm actually proposing to do another master's student master's thesis in that direction summer. It's related to information theory. There's something called maximizing mutual information as a means of feature extraction, and that's used now increasingly as well. And I think there might be something to using mutual information as a means of how do you combine signals. So the goal of CCA is dimension reduction on 2 very different data sets while simultaneously as much correlation present in both. It can be found in closed form, and there's many different solutions. The standard eigenvalue problem, we typically use the single value decomposition. SVD is much better. You know, if you guys know, if you're dealing with covariances, you don't use eigenvalue. It's much less efficient than SVD. It's much more. And I only know this because people told me this, and I've been enough times that I've seen it in MATLAB. But yeah, use the SVD first. And then people use also generalized eigenvalue problems for it. So the typical way for doing that is to form the cross correlation matrix. So you take your returns and you divide by the square roots of the volatility. And remember, our returns we already assumed they had means of 0. It's more complicated to consider non-zero returns and non-zero students. And we do the same thing for the x's. When we build this correlation matrix, this correlation matrix, this is exactly correlation. This is a public statement for correlation, but in a matrix sense. And then we can perform the SVD on this correlation matrix. The singular values, order from smallest to largest. The canonical variates are just the scaled directions. So the canonical variates, I guess we say here, are the scaled directions multiplied by the correlations. And the canonical correlation is just the singular values of that type. In general, we would replace population moments with sample counterparts, or we work on some matrix smoothing methods for trying to do this. Now, I can't remember why we put this in here. I know that Vincent had worked a lot on random matrix theory, and Oh yeah, well, of course. In high dimensions, there is a pretty high chance that you will get, that depending on the dimension, on the cross-sectional dimensions of the time series dimension. So the cross-sectional dimension, if there's a long time series, if it's tall and narrow, even if you had completely independent, you're still going to get some low correlations just by chance. If you have really short and fat data series, so just wide and not very many time series, then you're likely to get some very high canonical correlations. So sample canonical correlations become more dispersed for large values, and as a consequence, we justify that we need to clean it. And it turns out some of our cleaning, this is all empirical, so some of it was successful, some less so. Okay, this is not that useful. Okay, yeah, apply SVD of cross correlation matrix, that's fine. And so one thing I should point out, when we ignored, there was a term that we assumed was zero, and we just made this presumption that it was zero, maybe with the B script. It turns out that the A matrix can be expressed in this form. If we assume it's zero, so we don't even have to worry about, we just manipulate the matrices. If that second term, which I could go back to, but it was a second term that we canceled out. If we assume it's non-zero, then it turns out we want actually a nonlinear function of PSs. And it's a very simple nonlinear function, and I can express it in closed form. So it's not just a sum of the uncorrelated long short portfolios, but we potentially downweight some of the high canonical correlations. Oh, here it is. Yes, here it is. So in general, we said we had the approximate solution, where we just exactly that. We use the full solution. Then what we have is that the S's should be is basically this one, S over 1 plus S squared. And it turns out, okay, yes, it means for high observed correlations, you're going to depress them quite a bit more, and for the low ones, you don't change them at all. In practice, we found that this one works very well, just not even messing about with them. Mostly because the canonical correlations, it's more important if there's a dispersion between the canonical correlations that you observe in your data. If there's no dispersion, then it might as well consider it to be linear. I mean, each little piece of this is linear. I think it's very close to that, of course. So, what's the financial intuition of doing this assessment? So basically, we found uncorrelated strategies and orthogonal signals. Each of these strategies expresses a certain weighted combination of synthetic acids and synthetic signals, and these can combine. These are combined as singular vectors, which we refer to as canonical portfolios. So the ordering of the canonical portfolios. The highest canonical correlation corresponds to the most linearly predictable canonical portfolio, most predictable given our signals. And then the second one would be the orthogonal, the second most linearly predictable portfolio. Second highest canonical correlation corresponds to the second most linear. Now, as you see, that it sort of makes sense that we want to look at nonlinear, at nonlinearity. The question is, by opening, if we look at kernel CCA, typically when people solve kernel CCA, they only look at one result in canonical variant. Because the sense of what is orthogonality for nonlinearity is a bit more, it's not as well defined. So now essentially, by trading multiple of these, the optimizer is able to assign capital to strategies that had high correlations and also orthogonal each other. So we may not just want to trade the first one, we may trade the second orthogonal, second most, or the third most predictable. And by doing so, we would get diversification. Now, in terms of, okay, the returns, and the, okay, this is sort of the theoretical Sharpe ratio or information ratio for each of the canonical portfolios. And it turns out you can express it in closed form as well, in terms of what the canonical correlation is. Okay. I'm going to skip this as well. There is a, you know, the ability to, you know, we expect, of course, higher returns, more diversification we have. We expect that we want to trade as many orthogonal portfolios as possible. It turns out those with the smaller canonical correlations are typically those that are less significant. Okay, so we actually looked at this then in a back test, just as because the approach was basically more of an empirical approach, although there was some theory behind it. The goal was, how can we find a strategy that actually works? Now, typically, there are estimators for doing typically, when one looks at a large covariance structure and you want to fit it into an optimizer, there are different ways of going about reducing the dimension, or controlling for the not having an infinite sample size. And so in equities, people usually use economic factor models to sort of reduce the dimension of or to constrain the covariance structure. Increasingly, there's use, especially in statistical arbitrage, people looking at large covariance matrices and wanting to control the eigenvalues and not to zero them all out, but to make sure that they're not overly large just because it was an artifact of the small sample size. And increasingly, so the ways that people do this is linear shrinkage, and we consider that. That's the Ledois and Wolf were the ones that we usually refer to as coming up with that, where it's like a Bayesian estimate. You take a covariance structure, you take the identity, and you push it close to the identity. So we're in correlation structure, you push it close to the identity. And you're effectively depressing all off-diagonal elements by doing so. That's a linear regularization method for covariance structure. It's possible to do nonlinear regularization. And again, Ledois and Wolf is one of the big proponents of this. Also, Bloom, Bouchot, and Potters have a variation on that, which actually I think Ledois or Tan and Zorin have another variation on that using cross-validation. So we're going to look at, we would consider approaching these, and we did. We experimented, we considered all these different linear and nonlinear and just sample as well to see which worked better in practice. As well, we also considered what would we do with the cross covariance, because that's not as well defined. So in doing our analysis, we also considered competing portfolios. So given the time series, we considered having two canonical variants. So our proposed CCA analysis was based on using two canonical portfolios. One of the competitions was just plain mean variance optimization, just rolling mean variance optimization. Do it for 1 year and then put down periodicity. A second one would be the principal portfolios, the Kelly, and so on, and using two principal portfolios as well. And then we also looked at, well, what if we just sort of equally weighted all our assets, have the same strategy, we will keep deploying all the assets and we just do it. Or the weights are the signals. They're weighted by by how strong the signal is. And as a consequence, we can and then in doing so, we look at the covariance returns in CP2 and MBO are estimated using linear shrinkage by Ledois. We also apply linear shrinkage to the covariance of CP2, but choose a high shrinkage intensity without relying on the asymptotic formula for the Ledois. purposes. It was developed for financial returns that are, so it's, the shrinkage that the law proposed for financial returns. It can be, there are, I think it can be sidekick learn, you can use it, and it will tell you what the appropriate shrinkage should be. But it doesn't necessarily tell you what's appropriate for signals. So we had to muck about with what that was. And so they assume that they're independent, but we don't necessarily assume that they're independent and identically distributed. Now, our data, we used various different data sets. And the way it's implemented now, of course, is the futures, as I said, whereas we were looking at very easily available data sets, the common conventional portfolios. So there's 25 or 100 sorted portfolios based on book to market, based on operating profitability, based on size of investment. You guys know common French, they showed this. If you had, this is a type of APT, arbitrage pricing theory method for decomposing the returns of the market. And they're one of the first successful way of doing it. You have to divide into different portfolios and use those to regress market returns. Now, the portfolios are updated or rebalanced on a 21 business day basis. And we only include assets with complete history of over 120 months and for the subsequent 1 month. And the auto sample period here is from 74 until 2022. So it's constant, we get 578 monthly out sample returns. The signal, okay. For the signal, okay, I said it was reversal, Vincent said it was a reversion, because it was a momentum. It turns out that equities, single stocks tend to revert over short rises. Portfolios tend to trend over short rises. And portfolios trend over long horizons. So this is actually, it's a reversal if you considered it for a single equity, which initially we did, we certified rated equities. But in terms of for portfolios, it's actually a trend. The economic, okay, so you have to disregard my economic rationales because that's appropriate specifically for mean reversion for single equities. But we were able to compute this 21-day moving average, and we cross-sectionally demean it, we standardize it, we Windsorize it, and we're able to. And then we looked at how many significant canonical components are there. And we did this. I'm trying to remember exactly how, some sort of randomization method. We found that that there were actually two. It turns out just because these two lines above that red line, that there were two that were significant, and the third was very questionable. And that's not necessarily I'd have to refer to the papers to how we decided exactly that. There are other ways to go about doing this. One would be we also considered putting a penalty in and letting it be chosen automatically. To choose to do a penalty for the number of significant singular values is something like doing what's called a nuclear norm, is like the L1 penalty on the singular values. It tends to result in sparsity or zeroing out a bunch of singular values. That's not something we did. It could be something if we wanted to use a convex optimizer. Okay, so it turns out if we look at the Obama French 25 by book to market, and this is now sorted. They're scaled by their standard deviation. Sorry, these never appeared in the paper. These never appeared in the paper, but this is the this is a canonical portfolio, principal portfolio, univariate, and mean variance was the worst. We could do the same thing for. There's a bunch more. Here's the sort of investment sorting. Again, we outperform, and then we're much closer for this operational income. Again, we tend to do better in a lot of cases. I think in this specific case, principal portfolios outperform us. Okay, and then there are a lot of tables here as a resulting Sharpe ratios. Now, the Sharpe ratio here for this monthly rebalancing, it's not something to write home about. It's 1.01 here, or 0.85 or 0.79. It's not that amazing in and of itself, but there is some promise in the fact that we can actually, right now we're just using one signal instead of signals. We can use multiple sets of signals and do even better. And one of the other things we wanted to look at is not just that, it's also the turnover, because we're not accounting for transaction costs. So if we have very high turnover, then we're going to eat away that income. And it turns out our turnover is comparable, if not lower than some of the others. And we considered the Sharpe ratios in different subsamples. I'm happy to supply the slides here. They're maybe a little easier to read than the paper. And we looked at them, what happens if we forecast for, here we did the Sharpe ratio where we forecast for 1 day, that's significantly better. With 5 days, 10 days, it's a little bit worse, a little bit better the more often we rebalance. Of course, we did incur more transaction costs. But the other thing we can do, and this is based on the shrinkage intensity for the signals, because that was not fixed by theory. And the different lookbacks, the different window size lookbacks, and this is actually important because here we look at a 42-day look back, 63-day look back, and then we look as well as a 252-day look back instead of this. And then here we get an okay Sharpe ratio all over again. The 21-day was the best, and this was the second best. So it suggests that maybe we should combine the two. And and then here, this is the question of whether we use approximate solution versus full solution. We did both, and it turns out it's not that different. But sort of the theoretical versus the approximate solution, in terms of their returns, in terms of for instance, their Sharpe ratios, the approximate was was comparable and sometimes better, actually oftentimes better than in terms of its performance relative to the full solution. Now, what if we combine two signals? So here we combine both this 21-day moving average and this 252-day moving average, which we can't. We just don't have square matrices anymore. And it turns out that we get significantly higher sharpness. Instead of 1.08, we get 1.74. And this is monthly rebalance. We do this on a daily basis. So what is currently in production now is doing two signals, daily rebalance, and Sharpe ratios 2. So that there's a fair amount that one can do here. So this again, performance using 21-day and 252-day signals. And I guess one of the things that was of particular interest, I don't have any slides on it, sorry, is that despite the fact that we can put in momentum signals into this meat grinder that spews out allocations, the resulting portfolios are not very well correlated to the univariate. So the univariate portfolios is work very much like how a CTA would perform its global momentum fund. And you say, oh, look, you have momentum in this asset, momentum in that asset. We'll just wait and combine how strong the momentum signal is in each asset. We'll just combine them. And it turns out that if you did a momentum on, so they did it on futures. So you did a very large cross section of futures. If you did momentum in futures, you consider instead of CCA in futures, where you have to keep the two canonical variates, the correlation is less than 30%. So despite the fact that you're putting in momentum signals, there's so much more mixing and cross momentum is going on effectively. One momentum on one asset class signaling to invest in another one, that the correlation is going down. It's no longer effectively momentum, but has good returns in some correlates, some of the assets that are typically true. Okay. So conclusion, I say we presented a simple framework that generalizes Markowitz and does it in one stage. And there's a fair amount that can be done, more that can be done. It's a reasonably novel decomposition using CCA. Allows for greater transparency. We can compare to prevalent asset allocation frameworks which utilize signals. We tend to do better. We did employ some covariance estimation techniques And innovations of our own, but there's more that can be done to things in the sample size. I was considering this wouldn't be necessary. The further work to be done in terms of multiple heterogeneous signals and nonlinear extensions. So where you have, I'd like to be able to just throw in lots of signals, not have to worry about it and let it decide for itself. And nonlinearities. Transaction costs and signal decay, we considered to some extent a slightly variant solution. It was more about how closely do you get to a target portfolio. But in reality, the whole concept of when we did our allocations, they were not transaction cost data. They were just, let's just allocate and ignore transaction costs. But we can consider, various different transaction costs. How can we accommodate them and either slow down allocation based on the size of the signal? Perhaps we're still trading the same portfolios, but doing so less frequently, depending on what the sort of canonical signals are. And then we want to consider applications of different things. So I think there's some interesting questions in some of the empirical literature saying fixed income about forecastability of the yield